It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Yes, it's your real estate breakfast right around Australia, streaming your property news from the Sunshine Coast to Adelaide and from Launceston to Canberra, plus all of those regional markets across the country. And so many of those markets are running hot with investors looking for affordability, great yields and returns. It is a Thursday morning, May the 14th, and talking of returns for investors, the federal budget have investors reconsidering their options. Good morning to you, Graham in Brisbane. Thank you so much for taking the time to email us. You say that you're a long-time listener, first-time emailer, and that you're a 62-year-old and you were happy with your 10-property portfolio asset base. But after the budget on Tuesday, you've decided to sell off 3 properties this year and 3 properties in 2027 and the rest of your portfolio in 2028. You say that you are done and dusted. That is it. The budget has accelerated your exit strategy. You can't see, you say, how this will improve the rental market, especially long term. Well, thank you for your email, Graham. Really appreciate your thoughts. And if you are an investor, have you had similar feelings to Graham, or are you someone with one property who is looking to buy your second property? And has this caused you pause to reconsider your strategy entirely? Your comments, your views are always welcome. You can leave your voice message in our voice recorder below. Details are in the show notes. Or you can email us, myrealestatepodcast@gmail.com. The negative gearing changes are effective immediately from budget night, while the updated capital gains tax framework is scheduled to begin from July of next year. And off the back of that, let's welcome in Tim Brown. He is the CEO of residential mortgage group Recludo. And good morning to you, Tim. Welcome on to the Real Estate Breakfast this morning, where that is a very interesting email from Graham there in Brisbane.
Yeah, look, obviously very decisive in his response to the budget. I would suggest Graham obviously made a decision that probably needs a little bit more thinking through, because the budget isn't hindsight, so it's grandfathered. So anybody who's already bought an investment property isn't really affected by this legislative change. It's only properties that are being bought moving forward. And I think if anything, it just brings the whole property question into play to say, well, our properties need to be looked at more as a long-term investment, and in the sense of, its yield as well as its capital growth. I think a lot of properties are bought on the prospect of capital growth in the current climate, but I think the existing environment also questions, whether you're going to get those same growth capabilities. And I think the government's now predicting, instead of, the 4 or 5% capital growth that we've been experiencing year on year, it's going to probably be more like 2 or 3%. And I'm not sure if that's actually in relation to the budget. It might be more in relation to the slowing of the economy, which is a different scenario in play. As you say, that's how the economy is going to be affected by everything that's happening in the world today. And obviously the Iran war is top of that. So my first thoughts is, for those who have already got investment properties, business as usual, really. It's for the new investors, people who are wanting to increase their investment portfolio. They'll probably just need to do a little bit more homework around what the returns of that property would be.
I get the feeling that perhaps Graham was going to buy some more properties, which may be influencing big time that decision. Now, restricting tax deductions to newly built investment properties only, many investors are now trying, of course, to understand how this could reshape demand across established housing markets and apartments. Tim, how significant could these changes become for investor behaviour and lending activity, do you think?
It's funny, the government introduced this exception to the policy based on that they would get more home builds, but they really haven't addressed the issue of builders, the lack of skilled workers in Australia and also available land that's been developed. So increasing or allowing, the full capital gains tax as it is today on newly builds probably isn't going to work unless you fix supply. And they haven't really addressed supply. There's going to be a limited amount of new homes built because lack of skilled workers and lack of land that's currently been released. If anything, you're going to probably see an explosion in that space from investors and potentially prices increasing on new homes, which really doesn't address the whole issue of capital gains, which is to try and make homes more affordable.
So long-term property investing, let's look at that, particularly for higher income earners and those using family trust structures. And there's thousands and thousands of these around the country. Some say that the CGT changes may reduce appetite for investment properties over time. How do you read that picture?
Yeah, look, I think no doubt that it will bring into question, again, the viability of property as an ongoing asset class, so, is there a better option other than property? But I think at the end of the day, the tax increase, certainly on trust to 30%, I think is still reasonably within the framework of making a reasonable decision on an investment property. And I think if an established property still makes sense, the small tax increase on the trust, I don't think will change that too much. If it's a good investment, people will continue to buy it. It might bring into question those properties where negative gearing was probably more of an impact than the return on the property itself over time.
And many investors with these multiple properties, they may well be now reassessing portfolio structures, borrowing strategies and future acquisitional plans, just like Graham there in Brisbane is doing. What conversations then are you already expecting mortgage brokers and lenders to start having with property investors after these budget announcements?
Definitely, you will see probably some changes in relation to lending policy. Obviously, on established properties without the ability to negative gear anymore, obviously that will bring into account tax rebates that they were probably relying on to improve their overall tax position. But generally, I think most of the lenders take it on their existing income, not future tax rebates. So that probably won't be affected too much. I think interest rates are probably going to impact that more than the budget. And we're already seeing that with lenders putting a 3% buffer on, the current rate, which, it's taking it into the 8s and 9s that they're assessing your ability to pay that debt on. There's certainly a reduced number of people that will qualify for a loan for an investment property at the current time. And on top of that, most lenders only take 80% of rental income into account when they're assessing the applications. I think you'll find a lot of those lenders will tighten up a little bit, which will make it even more difficult, as you say, to get finance approved to buy investment.
We are talking with Tim, and in a moment we'll look at why property investors are becoming more reliant on brokers. That after this.
It's the Real Estate Podcast, talking properties from 6 a.m. every day from every corner of the Australian real estate market.
And right now it is time for another property tip, and recently we were talking to Monique up there in far north Queensland in Atherton, and you've got a property tip when it comes to buying larger blocks of land.
Yes, I do. So when you're buying larger blocks of land, it's important you ask, can it be connected to power, mains power? If not, still doable, but knowing that up front is a really good indication because sometimes power can obviously cost a bit to set up too. So knowing what cost you're going to be looking at. Water too, making sure it has access to water. Road access too is something that the lenders will look at. So asking the question, can you build on it? And what's it going to cost to actually put a residential property on that piece of land? Because these are things that the lender will look at and the lender will determine, is it actually a residential block? So ensuring you understand the zoning of what you're purchasing is also come into play when we talk about more rural lending, larger blocks.
Eager to expand your property expertise? Enhance your real estate know-how with us.
And it is a Real Estate Thursday. Tim is here from Recludo this morning. I want to talk about, there's plenty of talk around AI at the moment, Tim, reshaping financial services. How much do you think AI realistically is going to change the mortgage industry over, let's say, the next 5 years?
And we're already starting to see the impact of AI already through some of the lenders, as you're probably well aware, through a lot of the news articles recently of some fraud that was committed by some external referring parties. They actually weren't brokers. But then obviously those fraudulent documents made their way into brokers' hands, which obviously they're not skilled or trained in the ability to identify fraudulent documents. So the lenders have now put in AI type software that can identify irregularities in documentation, which makes a lot more sense because they're at the end of the day, they're the ones who make the approval. We're now seeing that being implemented in a number of lenders, and they're starting to pick up some of that fraudulent document. It's still a very small percentage of the total market, but it's still prevalent. And with AI, of course, the fraud is getting better as well. The documentation looks more real, harder to identify. When you look at a bank statement, it looks exactly like any other bank statement, but there are irregularities in the document. A piece of software or AI can just identify and then alert the lender and potentially the broker as well, because some of the aggregators are now introducing the same software into their system so that to assist brokers in trying to help establish that those referrers who are using that sort of fraudulent documentation.
Yeah, so much of this scam, this fraudulent activity. I had one a few weeks ago saying that if I did not pay my traffic infringement, I would end up in court. Everything looked and sounded legit, but I just ignored it. And I think a lot of people these days, if you're not sure, they just ignore because so much is coming through. Now, let's have a look at property investors and why they're becoming more reliant on brokers. This is a good one because with higher interest rates, tighter borrowing conditions and changing lender policies, investors, they really are. They're relying much more on mortgage brokers for strategic advice rather than simple loan comparisons. So, are brokers becoming more long-term financial advisors for many Australian property investors rather than just these loan arrangers?
Oh, definitely. And, there are policies between lenders that can give you the ability to lend more, and that's not generally available on the comparison sites. The broker can identify those lenders that make it easier for an investor, firstly, to borrow the amount that they need, and also potentially at a lower rate than probably the lender that they're talking to. As you know, a broker has the ability to cross over hundreds of lenders, and some of those non-bank lenders now are becoming very competitive because they're not governed by APRA. They are able to only use a buffer of 1.5% instead of 3%. For the investor, they can qualify for more money if they need it, and obviously they still have to afford it on the 1.5% buffer, but it makes a big difference when you're getting qualified on a 7.5% rate versus a 9% rate, which is the future rates that the banks are installing because of APRA's requirements to put that buffer in place. It makes a huge difference in your capacity and your ability. The non-bank lenders are becoming very competitive. I attended a conference last week with a non-bank called BC Invest. They were up 54% in volume on the prior year.
We'll wrap it up there. Plenty of great points that you've made for our Real Estate Breakfast audience this morning. Thanks for coming on to the show and enjoy your Thursday.
Thank you.
If you're a new listener, welcome. We talk to the most knowledgeable real estate experts across Australia every day from 6 a.m.
Sydney hasn't been booming in the last few years. People who buy in Sydney, which is obviously Australia's most expensive property market, they're buying because they fundamentally can afford to invest in Sydney. It's an expensive market to invest in. They're generally dealing with a cash flow deficit or they're negatively geared for quite some time.
So if an investor, let's say, owns 5 properties, 3 houses, 2 units, and suddenly comes under financial pressure, what do you think are the smartest options available in this market and in that situation?
What they often think to do is look at the one that's going to ease their cash flow first, but that's really the wrong way to look at property decisions. They really do need to be looking at, well, what are the assets that they hold? It's not always the case that all units perform worse than all houses. It very much depends on what type of unit, where it's located. And some houses that have particularly poor yield might have fantastic capital growth because of the land value.
We connect you to the best real estate information across Australia. The Real Estate Podcast.